Hello, everyone. I'm Gayatri from Index One, and I'm joined today by Brendan Raymond from Alice Exchange to talk about how proprietary AI models can inform investment decisions. AI is the most talked about topic right now. It's deeply integrated into our daily lives, and in our industry, that translates to using AI to power the creation of innovative, high performing strategies that fit naturally into investor portfolios. According to Mercer's 2025 AI in Investment Management survey, 91% of asset managers are already using AI in their investment strategies or plan to do so. On the product side, a 2025 report from the European Securities and Markets Authority, or ESMA for short, identified 145 EU funds that disclose the use of AI or machine learning in their strategies, though only a small subset classify AI as a core investment method. These figures make one thing clear: AI driven investing is no longer a niche trend, and it's becoming a defining feature of modern portfolio construction. At Index One, an index calculation platform, we've seen a wide range of AI based indices, some built from AI generated signals that convert directly into index weighting files, and others that track the performance of AI focused companies. And that's why today we're very excited to feature Brendan Raymond from Alice Exchange, the creator of the Alice AI Enhanced Index. Developed through an 8-year R&D program, this strategy provides benchmark-centric exposure with strategic AI-driven tilts aimed at improving performance. This index is particularly interesting because the AI model determines which constituents are included. Brendan, can you tell us more about the index and what motivated you to create it?
Yeah, sure. Thanks for having us, G. It's great to be here, and yeah, look forward to this discussion. I mean, we don't claim to be experts in any way, shape, or form about AI, but as you mentioned, we've been at this for a while. We started in 2017 with the rise of machine learning with TensorFlow, and happy to have a good discussion, share a couple of things that we've learned along the way, some of the mistakes we've made, some of the things we got right, some of the things we've got wrong. Yeah, so onto the index. Happy to chat about that. I mean, there we go. Yeah, that chart's a great chart. This sort of as a nice example of the journey that we've been through. Essentially, we started back in 2017 with the rise of TensorFlow and machine learning. Back then, it was more big data and advanced analytics. And I started I was a portfolio manager in a discretionary fundamental asset manager. And we asked ourselves the question, can we use big data, advanced analytics, and machine learning to enhance the portfolio manager process? Can we use what machines are good at, pattern recognition, data analysis, to help assist the portfolio managers in getting more returns out of their process? And so we looked at this quite simplistically, and we said, what does a portfolio manager do on a day-to-day basis? And for most of us, that's looking at charts, hundreds and hundreds of charts on a daily basis. And the more you look at charts, the more you get a feel for charts. The stock's overbought, it might mean revert, or the stock's oversold, it might mean revert to the upside. And we said machines are exceptionally good at doing pattern recognition and data analysis. Let's see if we can apply this in a machine learning context. And so that started the journey back in the day. You can see through this chart there, we've had some rises and some falls. We've learned a couple of things. Some of the early sort of learnings there around sort of backtest errors, and we can maybe get into those a little bit later on. But this is an index that we've created now. The latest index is our AI Enhanced Index. This essentially is the full evolution of 7 or 8 years of work. And initially, the process started out by feeding in essentially charts, and the machines are exceptionally good at reading the shape of the chart as well. And so we feed price and volume data, structured market data into our models. We have our feature engineering elements where we sort of convert those into machine readable processes. We have our machine learning layers and our backtesting engines. This essentially then spits out a ranking table from 0 to 100, which we can then do a lot of things from. So I'm sure we'll get into it in more detail, but the specific index that we've created here is this AI Enhanced Index. The client that we created this index for was looking I think a lot of where the market is at the moment is being very bifurcated into two separate groups. You've got the beta packet, and then you've got the alpha packet. Beta is essentially cheap. It's a race to the bottom. It's very easy to get your index exposure with iShares or Vanguard or any other provider. The alpha packet's been farmed out to sort of hedge funds or private credit, and people are willing to pay more and more money for this. And what our client was looking for was they were looking for beta exposure. They wanted the beta exposure with a little bit of an alpha element on top. And so we decided to build this product here, the AI Enhanced Index, which uses the AI machine learning signals that we generated, enhancing the US 500 US 500 index to generate 3 to 5% alpha on a very limited tracking error.
Thank you. And how would you say that this index differs from other AI-driven indices in the market?
Yeah, I mean, it's interesting. I think, as I mentioned, there's a lot of people trying to do a lot of interesting things out there, and we've had a lot of discussions with, I think in the AI space at the moment, everyone's quite open to see how we can apply AI to investments, and companies are trying natural language processing. We've seen machine learning techniques be applied to grouping and categorization. The way that we've gone and built about it is, as I mentioned before, is just saying what can machines do exceptionally well? That's pattern recognition, and feeding that in to solve one or two simplistic processes for the portfolio manager. Though along the way, I think one of the big learnings, and you have that's the sort of slide there, is that we realized we needed to build an integrated platform. I use this analogy often like a tent in a house. If you want to go out into the woods one night, you build a tent. It's going to protect you from the sun or protect you from the rain. That's fine. That's like building one machine learning model. But if you're trying to live in a house for 4 or 5 years, be protected from weather over a number of seasons, a tent really just isn't going to cut it. And so we realized to build at scale, to keep this, to stay ahead of the decay curve, to continually build machine learning models that's able to translate signals into live, implemented, executed portfolios, we needed to build this integrated platform. And that meant sort of version controlled research artifacts, centralized repositories, reproducible build, consoles, centralized readable consoles. It was all these things that it took a couple of years for us to build out. And it was this learning that took us, we had to take a step back, sort of a big picture view and say, well, we might not iterate quickly in the short term, but spending the time building out this platform allows us to scale and go further, faster down the line. I think only 25% really of the problem is generating alpha. The other 75% is execution, risk management, implementation. And so coming out of the portfolio management context, knowing what it means to implement portfolios in an institutional portfolio at scale, we realized we had to go and build those heavy foundations, which is why we call it the AI Alpha Factory now. It's not just a tent, it's the factory that's able to produce ML models at scales. And I think it's because of this, we're able to ultimately refine our processes. We're able to get the most out of our techniques. We're able to really hone our skills along the way. And I think that's what helped us. It certainly is everyone's trying their own different way, but those are certainly the ways that we've seen we ourselves get uplift along the process.
Thanks, Raymond. That's very interesting. So let's now dive into the methodology. As always, to our audience, please note that this presentation is for informational purposes only and does not constitute investment advice. Past performance, whether backtested or live, is not indicative of future results, and the index is not directly investable. Brendan, could you walk us through the stock selection process, weighting approach, rebalancing frequency, and any other key elements that you've considered for this index?
Yeah, sure. So as I mentioned before, this was an index that we created specifically for a client. They came to us and they said they wanted to get the US 500 exposure with some alpha component. They were very specific about their risk buckets, their risk tolerance. And so they wanted a tracking error of say 2 to 3%. And they said, what can you get using your signals? What alpha can you get using your signals on these bounds? And so we went back to the drawing board, and our core process essentially takes these deep learning models. We generate on a daily basis signals of the entire universe, ranked 0 being the worst, 100 being the best. And we then applied this framework to the specific universe that they were interested in. So they were interested in the S&P 500, the US 500 universe. So we broke down all of our signals, all 1,500 that we get, into deciles. For the US 500, it was only 500. We broke them down into deciles and applied multipliers. We then sort of set this cadence, the rebalance cadence, to be monthly, which is in line with what the S&P 500 was doing. And how we went about that on a specific basis, you can see on the right-hand side, there's that sort of stock chart there. That's an example of Meta. So Meta, for example, is a 2% weight in the S&P 500. Given the client had a very sort of small risk tolerance, we allowed for a 2% risk bound over and above the benchmark weight. So that meant the stock in our portfolio, in our enhanced index, would never be more than 4% and never less than 0. I mean, obviously can't go below 0, but there was a 2% bound below 2. And so that was the risk bound that we placed on top of that. We also then have sort of a framework where we apply the deciles in a multiplier framework. So the best ranked deciles in our universe, based on our signals, we might apply a 2 times multiplier. So for Meta, if it's a 2% position, we might times a 2 times multiplier, putting in at 4. Our worst decile, our 10th decile, might have a 0.1 multiplier. So then it comes in at sort of 0.2% in the portfolio. So we do this for 300 stocks out of 500, as that's a close enough proxy without incurring too much trading costs. We apply it to all 300 stocks. We normalize it to ensure that it adds up to 100, and then we implement that and rebalance on a daily basis. Essentially, what these signals are doing is, given their structured market data, and having worked with them for a number of years as a portfolio manager in a sort of man and machine hybrid context, the signals are trading mean reversion and momentum and actively moving between them. So if you think about a stock chart where you've got the Magnificent Seven, and all 7 of them have gone up, but one of them has come down and has sort of split out from the pack. As a portfolio manager, you're going to look at that and say, well, it's most likely that one stock is going to mean revert and rally with the rest. Similarly, if you've got stocks that have all sort of fallen in a big sell-off, but one of them hasn't fallen, as a portfolio manager, you're going to look at those charts and see, well, it's most likely that stock is going to fall. So the core signals at the heart of them are just trading mean reversion momentum and ensuring that sort of these patterns catch up. When you sum that all into the benchmark, the S&P 500, you get a portfolio that aims for 3 to 5% alpha with 2 to 3% tracking error.
Thank you. And let's go on to the fact sheet. So you did mention that SPY is the benchmark that you chose. Why did you choose the benchmark, and how do you feel like the performance is faring as compared to the theme?
Yeah, great. So the benchmark was chosen largely by the client, which was great, super helpful for us. So we used the S&P 500 as the benchmark. As I mentioned, the goal is 3 to 5% alpha on 2 to 3% tracking error. If we look at the sort of since inception, or 5-year annualized, we're seeing that the index is doing about 14.5% annualized versus the S&P 500 at about 12.3. So between 2.5% and 3% alpha annualized. It's slightly lower than our initial 3 to 5%, but within our bounds. So very happy with that. If we look under the hood at the risk metric, Sharpe ratio is 0.8 versus 0.7 of the benchmarks, or Tino 1 versus 0.8. So we're really happy with the risk metrics and how that's playing out. The return metrics definitely doing what it says on the label. Year to date, we've certainly seen some softness. I think we're not the only quant fund that's seen some softness. Year to date, we're down about 5.7 versus the S&P down about 3.6. So this is within our expected tracking error. Never great to be on a drawdown, but I think the great thing with the systematic process compared to a discretionary process with our enhanced index, we've got statistical measures on a daily basis where we're able to track what our model's doing, what our rank IC, sort of our statistical metrics are doing on a daily basis. We know what's happening under the hood. We know how the drawdowns are faring, and we know, through experience as well, how to persevere through it. And so very confident that we're going to normalize this and get back to winning ways.
Thanks, Brendan. So At Index One, we offer a holistic index calculation platform that delivers fast, flexible, and scalable indexing solutions. And we help build indices based on fully custom strategies with tools for backtesting, index calculation, rebalancing, corporate action processing, and distribution. So the way we set up this index, the Alice AI Enhanced Index, was launched on our platform using a CSV file containing the strategy's weights and constituents, and the index is rebalanced on a monthly basis through our rebalancing corporate action tools by uploading a new CSV file with updated weights and constituents on each rebalance day. And so from backtesting to calculation, maintenance, and distribution, the full life cycle runs seamlessly on our platform. Brendan, how would you describe your experience setting up the index on our platform?
Oh, it's been super easy. The way that we go and generate our signals, ultimately it's within our system that we run. We sort of 6 modules, exchanges that are API powered. Within the system, it's really easy for us to generate the signals. Every month we download the CSV and we upload it into the Index One platform. It takes me less than 5 minutes to do all of our portfolios. So really great platform. It does exactly what it says in the label.
Thanks, Brendan. We're always happy to hear that. And I guess this is obviously a very exciting index, and I'm sure that investors are looking to incorporate an AI-driven strategy like this into their portfolios, and so we're very thrilled to be able to calculate it and showcase it to the right people. So, how do you think an investor can gain exposure to this index?
The way that we work specifically is on a client by client basis. So this index is something that we created for one client, but we've got 2 general paths that we like to work with. I think that suits clients' needs. The first is just as pure alpha signals. So as I mentioned, on a daily basis, we generate these signals for our entire universe based on our methodology. We have as a result of the full unified platform, it's exceptionally easy for us to develop new models and new signals based on client preferences. So option number one is just as pure signals. You're able to sort of ingest those signals, implement them how you want. You do the portfolio construction, your risk frameworks, your execution, to daily delivery, however you want. So that's the simplest, easiest way to ingest the signals. The second sort of more integrated way is a full data to strategy process that we run. That's more of a discussion that we run with the client, where we sit down with them and we start asking for sort of, what is the mandate that you're trying to solve for? What is the outcome you're trying to get at? And we work all the way back to data, identifying what data is necessary to go into this, building out the features, working on the sort of deep learning layers, the hyperparameter tuning and things like that necessary in the machine learning context, and then building the framework that then goes out to trading that strategy. For one client, we act as a sub-advisor for them as well on their strategy. And so we do the full implementation. We ingest our signals into their portfolio management system. We execute them and we work with their traders to trade them market and close for that strategy. So we've got these 2 sort of ways that we like to integrate. One's a lot simpler and a little one's more an outsourced quant house. If you're, say, a discretionary manager and you're looking to move into the systematic space, we offer that full end-to-end solution.
Thanks, Brendan. We're very proud to support Alice Exchange by enabling the end-to-end life cycle of backtesting, calculation, maintenance, and distribution for this AI-driven index, and we very much look forward to supporting more innovative strategies from Alice Exchange in the future. And for anyone that would like to gain more information about the models, our contact information is on the screen here. Feel free to head over to our websites or reach out to us via our email addresses, and we can definitely provide more information. Or you can also view the index on our website as well. So we're now going to move into the Q&A portion of the webinar. Please feel free to submit your questions in the chat box and we'll address them as they come in. In the meantime, Brendan, you mentioned in the first slide, you mentioned paying school fees earlier. Can you share a specific example of something, that didn't work, a lesson that fundamentally changed how you approach building these models today, and why you call them school fees?
Yeah, that's a great question. I suppose in hindsight, it's silly, but I think it's not a lesson unless it's silly. But never trust the back tests. Be extremely skeptical about any positive alpha that you generate. I think in that initial chart we have that early bump up where it goes up, and that sort of expectation is, some of our early runs we looked at it there. That's a back test euphoria back in 2017. We ran these models and we were ecstatic. We thought this is easy. We're generating 20% alpha, and then we realized it's a little bit more to it. There was we were overfitting to specific situations. We weren't generalizing well. We weren't able to navigate regime changes or even accidentally leaking data. It's one of those things that any serious quant is obsessive about, but it's one of the lessons that we had to learn the hard way. And we only started trading these signals live on Live Capital 2019, and then more seriously 2021. And so it's not like we went out there trading these signals irresponsibly on client money, but the industry's full of beautiful back tests that die when they go into reality. And we are so obsessive and skeptical of any backtest or models that we produce. Internally, we run them multiple times. We have statistical gates at every single element. If we generate something and it looks good, our first question is, what have we got wrong? It's only when you sort of get to 0% alpha are you then sort of able to start building real alpha on top of that. So I mean, that's one of those silly things that when you say it sounds obvious, but it's one of those hard lessons we had to learn early on.
Love it. Thank you for that. We have received a question from our audience. Hi, Padami. Excellent presentation. Lots to learn from this. Thank you very much. Just a general question. How do investors or capital allocators view these indexes versus the usual cap-weighted indexes?
Yeah, that's a great question. And so I think it goes back to how the industry allocates. And so I think we're seeing it more and more as like the industry, the diversion between beta and alpha is becoming more and more extreme, and you're having to pay up more and more for alpha, and beta is becoming cheaper and cheaper. And so we work for some clients have looked to implement our signals in a long short market neutral context, and that is a pure alpha bucket. So they're saying they're not interested in beta, they want to extract all of the alpha out of the signals. In that case, we sort of open up the risk bounds, we apply slightly different frameworks. That's a very different question, very similar signals along in a sense, but a very different output. For this specific client, they didn't want to give up their sort of index or beta bucket. They were really serious about maintaining that. They didn't want to pay 4% for 5% alpha. And so they were really interested in saying, can you enhance something without taking a lot of risk and without losing that core index exposure? And so I think the way that this specific index is viewed is as a usual sort of cap weighted index. I think for their exposure, if you say have typically, let's say 60% to a beta and then say 40% to an alpha product, they would allocate this within that 60% bucket that they're seeing as a beta play. I hope that answers the question. Yeah.
Thank you for that. And also thank you for your compliments, Padami. Very happy to have you participate in our webinars as usual. So another question I have, Brandon, is you've been working as a portfolio manager with these AI signals for 8 years, or I think it's been probably more than that. How has that experience changed how you think about integrating AI into an investment process? And what do you know now that you didn't know at the start?
Oh, yeah, so many things. Yeah, it's interesting because we started implementing these signals live. I was as a portfolio manager trading for a client a man-machine strategy, which was essentially a core bottom-up discretionary fundamental framework with a macro overlay. And then the third element was these machine learning signals for the timing and what ultimately ended up being a lot of the alpha elements in the process. So that was around 2021 I started. So that happened all through the chat GPT era, 2022, Claude Code last year. And so seeing this play out in live a real world, and there's a lot of parallels. AI, ML, I sort of see it in the same bucket. Agentic AI is exceptionally good at very well defined, very specific use cases where there's examples. If you think about prompt engineering, you've got to know the right questions to ask an LLM to get the best answer out of it. You don't just throw a generalized question out there. How do I improve my SEO? Or how can I be a better marketer? You sort of have to be a bit of a domain expert within SEO or marketing to know the core nuances, the right questions to ask. It's quite similar in this process as well with machine learning. You've got to let the machines sort of do what they're best at and be very specific about what you're asking them to do. One of our early sort of situations is we had this risk optimizer that we embedded into the portfolio construction process in the ML layer, machine learning layer. It was before sort of we split things out, and the optimizer was just absolutely destroying all the signals because we were trying to ask the machine to do too much. It was essentially the same thing as saying, fix my life, asking the LLM. It's just such a broad question with no context. You're just trying to get it to do too much. And so we realized having to split these out and get the machine to answer one specific question, rank these stock charts on a daily basis from 0 to 100. Ask that question, and then allow the humans to do what the humans were really good at, applying those answers, those signals, putting the risk management layer on top of it, and then implementing. And so I think, being able to break your process into different chunks, identify where AI can add value in each chunk, and don't try build one sort of unified system or optimizer, click a button and solve my portfolio for me. I see a lot of people out there trying to promote these things, and I think that's not where AI functions best. It likes very specific use cases.
Thank you, Brandon. Yeah, you've definitely got an interesting approach to how you utilize AI, to create these strategies. So yeah, that's very interesting insight. And yeah, just kind of segueing from what you said, a lot of firms talk about using AI, but you showed us a full end-to-end platform, essentially underneath this index. What drove the decision to build all of those, or that infrastructure in-house rather than using the off-the-shelf tools that are available to us? And what does that actually give you that others don't have?
Yeah, that's a good question because it was a key change in how we looked at this. Essentially, the answer is scale. It gives us scale, and asking the question at every point in time, can the scale for multiple clients, multiple, hundreds of millions, billions of dollars, or are we going to run into trouble? And off-the-shelf tools were fine for an MVP or a proof of concept, but they just didn't scale. We ended up spending more time fixing the connectors than actually doing the work. So once we got down to building this platform, taking that time to build a unified layer, it allowed us just to move way faster because we weren't constantly fighting the integration of these tools. And then in hindsight, actually, it ended up sort of future-proofing the business as well, because now with the rise of agentic AI, it was so easy for us just to plug a sort of a custom-built agentic layer on top of that. Because we had that unified security and governance layer, we weren't trying to speak between Python notebooks and Bloomberg and data all over the place. It was all connected. It allowed us to sort of plug the agentic layer on top of it. It was really secure. Data was really unified, and enabled us just to go from sort of being really efficient to being now hyper efficient. And so it was one of those hindsight things where I don't think we realized how important it would be, but had we not done it, I don't think we would have been able to move as fast as we did.
Wow, that's awesome. And I mean, here we are. Now you've got a strategy, and I think you are working on more strategies. What's upcoming for AlisAlpha?
Yeah, so we're working with a specific client around sector, something sector specific in the tech sector. Some clients like, we're able to break down signals into any universe or any subsector as well. So doing something in the US tech sector to try and to extract alpha there. Interestingly, we're also looking at the small mid cap space for one of the one of the sort of tier one banks, I think they're interested in saying how can we solve that? That's obviously an underutilized or underpenetrated sector. Most analysts don't really cover that, and so they're saying how can we use AI and machine learning to try and solve those elements. And so we're looking at applying some sort of that's a bit of a rebuild as well. You're using slightly different feature engineering, using slightly different data sets. So that's an interesting challenge. But yeah, so many things on the go.
Love it. And just out of curiosity, what are your AI signals telling you now, just, around market events and fluctuations? What are the
That's an
signals telling
interesting. Yeah, I mean, if I look at it's quite interesting because specifically our signals are long semiconductors at the moment, which is not what you would expect. Sort of interestingly, if I look at some of the top 10 positions, some of the key positions, yeah, long semiconductors, surprisingly long on Nvidia trade, which I think has been stuck in a range bound area for a while. So signals are long there. Um, yeah, I think for a long time our signals were defensive, and I think they've gone to a place where they're now looking to take a little bit of risk. But again, it's not the way that the signals work. I think of it more as like a multi-factor statistical arbitrage, without getting too technical, because it's not just a pure one-off bet in one sector. A lot of the time, the signals are trading within sectors as well. So it might be like a long Microsoft short. Or for a long time we had the long Google short Microsoft trade, which worked exceptionally well for us as Google came to prominence in the AI space. And so sometimes it's these sort of pair trades within sectors, sometimes it's pair trades between sectors, i.e., long semis and short software. So it navigates quite fluidly between them. But I think if I look at the screens at the moment, we've got a long on NVIDIA and a short with our sort of the counter matching short on Meta. So yeah, it'll be interesting to see how that plays out.
Yeah, I love that. Well, thank you. Thank you for sharing that with us. It's very interesting. Well, Brendan, it's been such a pleasure having you on. Thank you so much for your time. I think we had a
Yeah,
very timely and interesting conversation today. And yeah, I hope our audience had a thing or two to take from it. So thank you very, very much. And thank you to everyone, all of our audience, for your time and participation. Be sure to subscribe to our email newsletter to stay updated on upcoming video content. Thanks again for tuning in, and we look forward to seeing you next time. Thanks, everyone.
thanks so much. I appreciate it.